Happy anniversary. Today is the 33rd anniversary of the Black Monday global stock market crash. Not really something to celebrate, I know, but in this video, some reasons to be fearful and also some reasons to be cheerful about global stock markets today. Hi everybody, I'm Martin Bamford, and in this video I'm talking about the Black Monday stock market crash. I'm taking you all the way back to the 19th of October 1987, and on that fearful day the US stock market crashed by more than 20%. The FTSE 100 here in London crashed by 11% and then a further 12% the following day. So what I wanted to talk about was what happened 33 years ago, and are there any parallels we can draw between the stock market then and the stock market today? So some reasons to be fearful and also hopefully some reasons to be cheerful about investing your money. Now, my overriding memories of 1987 when I was 8 years old, so fairly young still back then, wasn't the Black Monday stock market crash, but it was the Great Storm. And actually the Great Storm of 1987, which happened a few days before Black Monday, played a role in amplifying the disaster that was Black Monday here in the UK. And that's because on the previous Friday, the London Stock Exchange was closed because of a storm. This was a storm, remember, which brought down around 15 million trees across the UK. It killed several people too. And it was really concentrated here in the southeast of England. So as well as the markets being shut on the Friday, many traders could not get to their desks for Monday morning. Train lines were still blocked, trees were down across roads. It was very hard to move around in the southeast of England. And I say I remember it very well. I actually slept through an oak tree falling through the roof of a neighbour's house that night. So as an 8-year-old, obviously slept very soundly, and I do have memories of the Great Storm, but not as it actually happened. So Black Monday back in 1987 happened on the back of a sustained period of stock market growth. Looking at the US between August 1982 and August 1987, when it peaked ahead of Black Monday, the Dow Jones Index rose from 776 to 2,722 points, including a rise of 44% in that year leading up to August 1987. So a sustained period of stock market growth, which really set things up for a major fall on Black Monday. There was also a huge increase in the volume of shares being traded on the New York Stock Exchange in that 5-year period. So it moved from 65 million shares a day being traded to 181 million shares in that 5-year period. So the increase in share volume was another factor setting things up for Black Monday. Ahead of Black Monday, economic growth had been strong and sustained, although it was starting to ease off a little bit. And just ahead of Black Monday, the US had passed a new tax law, which was seen as being quite damaging to investors. So those are some of the, reasons, some of the things building up to Black Monday. But there's a really good lesson here, and the lesson is that there is no clear overriding event or news story that prompted Black Monday to take place, that prompted this major sell-off in global investment markets. It happened, even with the benefit of hindsight. It's very difficult to apply a reason to it. And I think the lesson here is that causation and correlation are not the same thing. They happen in isolation. As humans, we love to apply a narrative to things. We love to say the stock market fell because of X, Y, and Z. But actually, in many cases, that is completely unrelated. It just happens. These things just happen without a specific news event causing them to take place. So when stock markets opened on Black Monday, there was already a lot of pent-up demand to sell shares. And in fact, 95 of the 500 companies that made up the S&P 500 index at that time were late in opening for trading that day. And that was to allow market makers to conduct orderly trading. 95 out of 500 because of all that pent-up demand to sell off shares. And then globally, we saw this contagion taking place. So traders around the world started selling off, not because of, again, any specific news or event taking place, but because of this environment of confusion and fear and uncertainty. And we entered a bit of a feedback loop. This volatility-induced sell-off was all to do with a feedback of news taking place. And I think this is such an important lesson for investors, that it's not always about news, it's often about noise, and it's really important to distinguish the two. Now, there's a bit we don't always hear about when we talk about Black Monday, and that is the rebound, because share prices crashed, sure, but they also came back relatively quickly. And in the following days after Black Monday, certainly in the US index, the Dow Jones rose 102.27 points the following day on the Tuesday. And then on the Thursday, it rose by 186.64 points. So it took until September 1989. But markets do tend to rebound after sharp crashes, and that's a really good lesson for investors too, because it's the investors who stay invested, who ignore that short-term volatility, that tend to do best over the long term. And as a long-term investor, even a traumatic, significant event like Black Monday really does just appear as a blip on your investment returns graph, because investors, real investors, measure their returns in decades. And it's speculators who look at the returns over quarters, months, weeks, days, even hours. But investors look for the long term. 33 years later then, what are some of the parallels we can draw today with that scenario leading up to Black Monday? What are some of the reasons to be fearful as an investor? And I have to say, as an investor, there are always reasons to be fearful. There's always something going on. And right now we've got the big ones, haven't we? We've got COVID-19, we've got a disorderly Brexit coming up, we've got the US presidential elections and whatever they might bring. I'll leave those to one side because they are the obvious ones. They're the ones that the news media focuses on. But there are always going to be reasons to be fearful. And when those work their way through, and when COVID-19 is consigned to the history books, as it will be one day, there will be something else to replace it. Something will step in to take its place. But I wanted to talk about some of the things that, whilst we might not be fearful about, we are keeping a watching brief on at the Informed Choice Investment Committee, things which are on our radar right now. So I want to start with the high value of tech stocks. Now, I started my career in retail financial services back in the year 2000, when the tech bubble was nearing its most inflated, as the burst was starting to happen. That bubble was popping back then. And there are lots of parallels between the tech bubble, the dot-com bubble of 2000, and the tech bubble that we're seeing right now with company valuations. And for me, the real tipping point was back in September, when the market capitalization of Apple, the Apple share price and market capitalization of that company, exceeded the entire market capitalization of the FTSE 100 index. So the 100 largest companies traded on the London Stock Exchange were worth less than the total market capitalization of Apple, one company in the US. And for me, that was a big red flag. Now, it's not quite there today. The current market cap of Apple, as I record this, is $2.06 trillion. And the current market cap of the FTSE 100 companies is £1.8 trillion, which translated into dollars is about $2.35 trillion. So the FTSE 100 today worth just slightly more than Apple, not by much, but slightly more. And it doesn't take much in terms of market movements, a movement in the Apple share price, a movement in the value of the FTSE 100 companies to readjust that balance again. But Apple is incredibly highly valued right now. It's very expensive by many conventional measures, and it represents a huge market capitalization. And that actually brings me to another reason to be fearful, and that is market concentration. And one of the examples I'll give here is looking at the S&P 500 index, so 500 companies in the US, large companies in the US. And of those 500 companies, 5 tech stocks make up a quarter of the market capitalization of the S&P 500. 5. So 1% of the companies in the S&P 500 make up 25% of its market capitalization, of its value. And that for me raises a huge concern about concentration risk. We know from an investment perspective that diversification helps to reduce risk. And as an investor, you might believe that investing across 500 different stocks or thousands of different stocks in an index is helping you to diversify. But when that index of 500 stocks is represented to the extent of a quarter by 1% of those stocks, by 5 of those stocks, that raises a severe amount of concentration risk. And this is being driven really by the incredibly high market valuations for tech stocks. So it's a reason to be fearful. Concentration risk, something to look at within your own portfolio. How much of your portfolio is exposed to a relatively small number of companies? You're not really getting widespread diversification by going into an index tracker fund if only 5 of those are worth a quarter of that index. I also worry a little about fraud, and specifically about undiscovered fraud. Now, just last month we had an example of this. We had a tech company chairman resigning following accusations by a fund manager that this chairman had made assertions which were untrue about the company's tech. Now, the hedge fund manager in question called the company an intricate fraud. I'm not going to go into details and name that company here. I think that's unnecessary, but it is a matter of widely reported public record what took place. And it's just an example. When economic times are tougher, then we tend to see a rising level of fraud within companies compared to when economic times are good. And let's face it, right now, economic times are very tough. So I suspect that undiscovered fraud is bubbling away there, and it's something that will become more widespread and damage stock prices for many companies in the future. The economist John Galbraith talks about covert embezzlement, and he calls it the Great Bezzle, or the bezzle. And that could play, I think, a growing factor in some stock price adjustments going into the future. So a few reasons there to be fearful. There are plenty others out there. You can find reasons to be fearful very easily. And of course, worth remembering that it's not the ones you're keeping an eye on often that jump up and jump out of the shadows and ruin the party. It's the unknown stuff, the unexpected stuff that tends to really cause some damage. So yeah, by all means, look at the reasons to be fearful, keep a watching brief on them, but recognise that it's not necessarily those which will prompt the next great stock market collapse, even if we can work out the reasons for that stock market crash before they happen, or when they happen, or even after the case. There are some reasons to be cheerful too. I like reasons to be cheerful more than I like reasons to be fearful. I'm an optimist by nature. They are much harder to find, and that's because news media takes that view that if it bleeds, it leads. Stuff that makes us happy doesn't tend to appear on the front page of newspapers for some reason. It obviously doesn't sell enough newspapers. But there are some good reasons to be cheerful out there for investors. I think my first one is cheap money. We've got such low interest rates at the moment. We've got huge amounts of quantitative easing, of monetary easing taking place. And cheap money is good for investors. And that's because the purpose of QE, quantitative easing, is to drive up bond prices whilst driving down bond yields. So interest rates become lower. Lower interest rates tend to encourage greater consumer spending, greater business investment. And that's because what's the point in keeping money in a bank savings account if you get such a low interest rate on it, even potentially a negative interest rate, something we'll look at in a future video. And also it means that banks are able to lend money more cheaply. There should be a bigger supply of money out there. So cheap money, I think, for investors is a good reason to be cheerful. Another one is the rise in ESG investing. That's ethical, social and governance tactics for investing. And there was a report out last week from PwC, and they predicted that ESG investing in Europe is likely to exceed conventional investment within the next 5 years. So they have forecast, PwC have forecast, that ESG products are likely to reach 7.6 trillion euros in the next 5 years. So I think that's something to be cheerful about. I know not everybody is a fan of this ESG methodology, but if we can invest money in a way that makes a positive difference to the environment, to society, I think that's a force for good. And I think longer term ESG funds should deliver a better return than so-called dirty investment funds, which are more short-term focused. ESG should be a longer-term focus. There are plenty more reasons to be cheerful out there. In fact, I would love to hear from you some of your reasons as an investor to be cheerful about the future and not to be fearful. You can leave some of the fearful ones in the comments below as well. I know you like to talk about those too, but leave me some comments below with your reasons to be cheerful. And please do leave this video a like. Make sure you subscribe to this channel for future videos just like this one. And until next time, I'm Martin Bamford from Informed Choice. When it comes to your money, the more you know, the faster it can grow. Thank you for watching.